Lesson 2. Welcome, ladies and gentlemen, to Lesson 2, Job Order Costing System. In this lesson, we're going to learn the fundamentals of a job order costing system, including using predetermined overhead rate. We're going to understand the difference between a job order costing system and a process costing system. We're going to go through an example of the job order costing system and the job order costing documents, and we're also going to learn the cost flow of a job order costing system through journal entries and T counts. Now, if you haven't watched Lesson 1, I encourage you to do so because the concepts relating to the schedule of cost of goods manufactured, raw materials inventory, work in process inventory, finished goods inventory, direct materials, indirect materials, all those kind of concepts we cover in Lesson 1, and they flow through to this Lesson 2. Alright, so let's get into it. I want you to have Lesson 2 cheat sheet in front of you. Turn to the side that says Concepts and Definitions. We're going to go through some concepts first, and then we're going to get into some examples. First thing, top left corner, process costing. Process costing is a system of assigning costs used by companies that make homogeneous products or services. Job order costing. Job order costing, a system of assigning costs used by companies that make customized or unique products and services. Now, so obviously there's two different types of costing systems in this lesson. If you guys recall from financial accounting, there was different ways of costing inventory. There was FIFO, LIFO, weighted average, specific identification. As you can see, inventory, there's a lot going on in inventory. There's different ways of costing the inventory. Well, there's also, in terms of flow, FIFO, LIFO, weighted average, but then there's also like how you assign costs. There's process costing, job-based costing, activity-based costing, absorption costing, variable costing. In this lesson, we're going to go through the difference between process costing and job order costing. And so let's move down to this table below, and we'll see there's job order and then there's process. So these are the two different types of costing systems we're looking at. The number of jobs worked in job order, there's many. In process, there's a single product. Costs accumulated by, in job order, individual job. In process, by the department. Average cost computed by, in job order, it's job. In process, it's department. So, process costing is used when we're making thousands of the same type of product within a department. Job order costing is used when we're making more specific products that require different levels of materials, different levels of direct labor, different levels of overhead. That's when we use job order costing, because we're going to assign cost to a specific job, job being like a product or a unit. And then process costing, if we're just making thousands and thousands of the same product, it's the same amount of material, same amount of labor for each product, we're going to use process costing because it's a lot easier instead of assigning it to individual jobs. Just part of accounting is doing things or being as efficient as possible. And then there's this concept of materiality, which we discussed in financial accounting. Materiality, if it's really not, if a cost isn't going to be material, you're better off excluding it or just estimating. Well, that's sort of the idea behind process costing, is all the costs are going to be the same no matter what, so just lump them all together and then allocate. Job order, well, it's going to be material because we're going to have specific amounts of materials and labor to a product, so we want to assign it that way. Alright, so moving on, we're going to talk about down below this, the job order process comparison table, there's additional definitions, and we're going to talk about the different types of documents used in a job order costing system. The first one is a materials requisition form, a form that lists the quantity and cost of direct materials used on a specific job, and this is used in the job order costing system. Direct labor time ticket, a source document that shows how much time an employee has spent on a job during a period of time, used in the job order costing system. Job cost sheet, a source document that summarizes all the costs assigned to an individual job, including direct materials, direct labor, and allocated manufacturing overhead, used in the job order costing system. Okay, on the other side of the lesson, cheat sheet, you'll see those documents. We're going to go through those in a second, but let's go through all the concepts and definitions first, and then we'll get into examples. Go to the top right, underneath concepts and definitions, we got job order cost flow. Similar to in lesson 1, we had a cost flow relating to period cost, product cost, and how that always got to the income statement. Well, we've got those manufacturing costs. Like I said, manufacturing costs, those concepts, definitions from lesson 1 are going to carry forward. Manufacturing costs, we've got direct materials, direct labor, manufacturing overhead. The source, and this job order cost flow, we're going to look at the source documents and where they go and how they're used. Okay, so the source documents used to assign direct cost to jobs. The direct materials go to a materials requisition form. That goes to a job cost sheet. Direct labor goes to a labor time ticket. That goes to a job cost sheet. Manufacturing overhead, well, in order to, and remember, manufacturing overhead, it's all these different costs that we can't trace to one specific product, rent, supervision. So we pool all those together, and then we allocate, based on a certain driver or an allocation base. And that's called our predetermined overhead rate. That goes into the job cost sheet too. Alright, so let's look at how we calculate that predetermined overhead rate. So the first thing we do is, so predetermined overhead rate, I've abbreviated POHR. A predetermined overhead rate is the rate at which manufacturing overhead is applied to jobs. The allocation base is a measure that allocates indirect costs to a specific job. Okay, so anyway, those are the definitions up here. Let's go to how we calculate the predetermined overhead rate. We take the estimated total manufacturing overhead costs for the coming period. So say it's a year. We have to. So let's estimate what our rent's going to be. Our supervisor labor. The annual salary of the supervisor, our total indirect materials, we estimate what those total costs are going to be, right? Part of what managerial accounting or part of the role of management is planning by budgets, so they plan for what the future costs. Remember the difference between financial and managerial, we're talking about future costs, so let's estimate what our future overhead costs are going to be. Put all those costs together, and then we're going to divide it by an estimated total number of units of the allocation base. So the allocation base oftentimes is direct labor hours or machine hours. I think in the example that we have for lesson 2, it's direct labor hours. So we take the total costs that we're going to have for a given period, we divide it by sort of the total number of direct labor hours or machine hours, and then we get a per hour or per unit rate. That rate is how we apply overhead. And we'll get into this in the next on the other side of the lesson plan. But if we come up with $7 per hour, that's how or $7 per labor hour, if that's how we're going to apply overhead. If a job, and this is job order costing, if a job takes 7 hours, well, we're going to apply 7 times 7, the hourly rate, times the number of hours. 7 times 7 is 49. That's how much overhead costs we're going to apply on top of the direct materials and the direct labor. That's the job order costing system. We take direct materials in the materials requisition form. We take direct labor, which is through the labor time ticket, and then we take our predetermined overhead rate and we apply that on the job cost sheet, and that job cost sheet is the total cost of the job. That's the job order cost flow. We'll get into an example, but before we get into an example, let's go through the journal entries. And I know you guys are all excited about journal entries. You've missed them very much since financial accounting. Also T accounts, can't forget those. Let's go through the basic journal entries that we're going to see in a job order costing process system or a job order costing system. These, we don't have any numbers in here. This is just conceptually understanding how the journal entries flow, and they're all linked A, B, C. The A and the B flow to the T accounts, so then you can link the two. So the first journal entry is to record the purchase of raw materials, debit raw materials, credit accounts payable, because now we owe something, right? Accounts payable, liabilities increase. Remember the financial accounting, we got the basic accounting equation, assets equals liabilities plus owner's equity. Well, so if we increase assets, we have to increase liability, right? Okay, B, to record the transfer of raw materials as direct materials to work in process and indirect materials to manufacturing overhead. Remember the schedule of cost of manufacturing costs from lesson 1? Well, we're taking that schedule and we're putting it into a journal entry in T account form. So you might want to have lesson 1 cheat sheet in front of you too, so you can see how those flow. But those from that schedule, it'll flow into journal entries too. But this is specific to job order costing. We're going to get into other journal entries for process costing, activity-based costing later. But this is process cost or job order costing. All right, so to record the transfer of raw materials as direct materials to work in process and indirect materials to manufacturing overhead. So we're going to debit work in process, Debit manufacturing overhead, credit raw materials, right? The basic accounting equation, we're increasing assets, so we need a decrease in assets. C, to record wages as direct labor and process and indirect labor to manufacturing overhead. So we're going to debit work in process, debit manufacturing overhead, credit liability, salaries and wages, because now we owe those. And then you'll look in it, and we'll go through the T counts after we go through all the journal entries. D, to record other manufacturing overhead costs such as property taxes, insurance, depreciation, rent, etc. So those are those types of costs that I was telling. We can't trace to a specific product, but we know we're incurring them, so we need to attach them to products so the management can monitor how profitable a specific product is, or a unit, or a line, or a segment. But we need to allocate certain costs so that we know the true value, or not the true value, but the true cost attached to that product. So examples of those manufacturing or indirect costs are property taxes, insurance, depreciation, rent, indirect materials, etc. So this is the journal entry to record those to manufacturing overhead. That's D. Now let's go to the middle. E, to record application of overhead to work in process, debit work in process, credit manufacturing overhead. F, to record the transfer of completed units out of work in process and into finished goods, debit finished goods, credit work in process. G, to record sales revenue and accounts receivable and the corresponding costs of goods sold and reduction of finished goods inventory. All right, so remember from financial accounting, when we have a sale, we need to debit an accounts receivable and we credit the sales revenue, and then we also debit the cost of goods sold and we credit the finished goods, right? So we're recognizing revenue at a higher, we're marking up the product, so that's going to be higher, so that's what we recognize revenue, and that's what our customer is going to owe us. At the same time, we're getting rid of a cost, the cost of the finished goods, and that's going to cost of goods sold, and we're reducing finished goods, right? Debit expense, credit asset. That's the second journal entry. Now, non-manufacturing costs, we're not going to look at those journal entries. We'd already understand those. It's basic debit, expense, credit, payable. But non-manufacturing costs such as salary expense and advertising expense are recorded as incurred. Remember, they're period costs. Period costs are expense as incurred. So we're going to debit salary expense, credit are payable. And then below that we got debit advertising expense, credit accounts payable. Those are non-manufacturing journal entries. And then we're going to record under and over applied inventory as follows. So over here in our definitions, we got under applied overhead. Okay, under applied overhead exists when the amount of overhead applied to jobs during the period using the predetermined